Guys, welcome back to the channel Trading Simplified. Today we are going to go over some funds and break down if you invest over 10, 20, 30 years, what it's going to look like. But I'm going to give you a realistic outcome, not just making 7 to 10% a year. You're going to see down years. You're going to see percentages where you lose 20, 30% in 1 year. I want to give you both the pros and cons to investing long term. And if you have time, please check out the links. You can see I created a WHOP here. I have Twitter. I have Gemini Referral Club. And when you click on WHOP, you get a more personalized experience. You can directly chat with me about stocks, chart levels, and trades. You'll get to chat. You'll get to see my YouTube portfolio holdings, my stocks, buys, and holds each week. But let's get into the video. Jump right into it. We're going to compare three funds. We're going to compare the S&P 500, Fidelity's FXAIX. We're going to compare a blue chip growth fund, FBGRX, and also the International Index Fund, FSPSX. Now on the Portfolio Analyzer, it allows you to, attach the U.S. stock market. So we have U.S. large cap for S&P 500. We're going to do a portfolio of 100% of that. Portfolio number 2 is going to be the U.S. large cap growth, which is mimicking FSBGX. And then we have the Global X U.S. stock market, which is portfolio number 3, which is mimicking the third one. So now if you see here, we're going to do a 30-year track record looking at 1994 to all the way to 2024. And we're going to start with an initial $1 amount. And the next thing that we are going to do is we are going to add a contribution amount of $500 every single month. So we're going to change this to monthly, and we can see we have a 30-year horizon starting with $1, $500 every single month. Let's analyze the portfolios and take a look. The first is US large cap, which is S&P 500. The second is large cap growth, which is your growth fund. And the third is your global international market. Now, what I want to show you is the nitty gritty. You can see that there are good years and bad years for all of these portfolios. If you look at the performance summary right here, we're going to show a graph of it, but I want you to see, look at the maximum drawdown. S&P 500, 1 year, 46% pullback. Maximum drawback of portfolio number 2, 43%. International, 55%. So it's not all sunshine and rainbows. You do have pullbacks. And we're going to add the inflation adjusted as well. So if you look here, you started in 1994 adding your $500 every single month. And then basically it was trailing at this 100K mark for a while. Now it's hard to tell because it doesn't look like it's gained that much, but it has. Because you can see right here is $100,000 and this is $1 million. So you started in 1994. By the time you got to 2004, which is 10 years later, your accounts were basically at, as you can see here zoomed in, at $65,000. Now, if you go 5 years from now, you get right before 2008, it was at its high right now. In 2007, your S&P 500 was at 128,000, your growth fund was at 120 grand, and your international surprisingly was at 155,000, outpacing the other two, the US stocks. Then 2008 collapse hits, and it pulls, your portfolio pulls all the way back 2009 to $75,000 basically for each one. So you went from 120,000 back down to $67,000 in each one. So not all sunshine and rainbows, but if you continue to follow the plan and buy $500 every single month, and let's zoom back out now, let's go another 5 years out from 2009 all the way to 2016. Now your account has gotten bigger at 250,000 in your S&P 500. Your growth fund is 260K. Your international is 187, and starting to see the U.S. markets pull away here. Now going all the way to 2020. So you are 26 years invested right now, doing $500, 6,000 a year. Your S&P 500 has 427,000. Portfolio number 2, your growth fund is at 484,000, pulling away from the S&P 500, and international is trailing big time by 200,000. And when you get to the end, you're not even at $1 million. Your portfolio number 1 is at 740,000, which is S&P 500. Your growth fund is 924,000, and your international is at 279,000. Now, I think it's important to consider that there's a good lesson in all of this, that you really need to diversify your investments, because although you'll look at funds that say, okay, 1 year return, 33%, 37%, 13%. You are going to have years where you have pullbacks, and it is very tough to hold in these markets when the stock market pulls back. So you need to continue the plan and make sure you pick the right fund to begin with. So look in 2022 as an example. Portfolio number 1, the S&P 500, pulled back 18%. That doesn't sound terrible when you look at the portfolio number 2, the growth fund in 2022, pulled back 33%. That is a monster pullback that is difficult for people to, continue to hold. So what I want to do is show you, although your returns were positive most of the years, you can see in 2022 we had that massive pullback. 2018 you had a red year as well, so you're buying and your portfolio is just decreasing in value. 2008 was nasty too, negative 37%, negative 38%, and negative 44% for international. And then you had 2000, the dot-com crash, with 9% pullback, 22% pullback, and 15% pullback, followed by, if you look at 2001, 2002, and year 2000, you had 3 consecutive red years. So this is just a good example of you will have drawdowns in your portfolio where you can see it clearer right here. And looking at 2000 that we just reviewed, you were down almost 50% on your investment. So this is not like you buy and you just get 7% every year. Your funds will go down in time, and the only way to mentally handle this is to know that you are continuously going to buy throughout time and let time work out for you. Because if you did hold out in time, it will pay off. Newer investors, I think it's good to see a video like this because the historical market stress periods, as you can see, you had the Asian crisis in July of 97, 98, the Russian default debt in 98, the dot-com crash from 2000 to 2022, the subprime crisis from 2007 to 2009, and the COVID during 2020. These were monster drawdowns with 50% pullback in the S&P 500, 53% pullback in the growth fund, and 58% pulled in international stocks. I just want you to see this because it's a wake-up call to every YouTuber telling you, you buy this fund, you're going to make 7% a year. You're going to have drawbacks. So you better make sure that you're picking the correct fund and continuing the plan of dollar cost averaging over time. If you want an easy way to follow the plan of automatic investments, click on this video right here, how to set up automatic investments. I'll post it at the end of the video as well for you to see. This makes an easy step-by-step how to set up your automatic investments, put it on autopilot, piece of cake. If you're interested in joining WHOP, right now it's currently $5 a month. The first 10 get this deal. You get real-time access to chat with me about the financial markets. You get complete transparency to view my YouTube portfolio, which you can see right up here in this tab. You can also check out the short-term and swing trading. And if you'd like, you can share your portfolio with me. I'll review it for you. It's beginner-friendly, and definitely come check it out. I appreciate you watching this video. Thank you so much. If you like showing some love to the channel, I appreciate it. Click under the community. You can support the channel. You can either do $1.99 a month or be a super supporter for $10 a month. Basically, you get these cool little loyalty badges, you get priority reply to comments, and you get the super supporter as well.